Resident minors are children under 18 years of age who are taxed under Division 6AA of the ITAA 1936 at higher rates of tax on particular income they receive. The general rule is that a resident minor is taxable on all income under Division 6AA unless either the taxpayer or the income received falls under any of the exceptions to the rule. Sarah is an Australian resident, aged 17 years. During the tax year, she derived $7,000 in wages from a part-time sales job and incurred $146 of deductions in earning this income. Sarah also received $8,000 in her capacity as a beneficiary of a family trust created by her living grandparents and had $500 of related deductions. So how do we work out Sarah's tax liability for the year? The first requirement for the application of Division 6AA is that the minor must be a prescribed person. A prescribed person is less than 18 years of age on the last day of the tax year and is not an accepted person in relation to the tax year. An accepted person is a minor who was engaged in a full-time occupation on 30 June or suffers from some incapacity or disability which prevents full-time employment. If a minor does not qualify as an accepted person, they will be deemed a prescribed person and all their income will be assessable unless it can be classified as accepted assessable income. So the first thing to note here is that Sarah is not an accepted person in that she is not engaged in full-time work and is not disabled or incapacitated in any way. Therefore, as Sarah is under 18 years old, she is a prescribed person under Section 102AC, subsection 1. However, her employment income of $7,000 is classified as accepted assessable income, and the deductions of $146 mean that the balance $6,854 should be taxed at normal tax rates and not under Division 6AA. Broadly, in accordance with Section 102AE, subsection 2, there are 7 categories of accepted assessable income, including employment or business income, investment income from certain types of property, non-business partnership income, and trust income assessable under Section 97 or 100. Sarah's other income comprises the distribution of $8,000 from the family trust, which is reduced by the $500 of related deductions. This leaves $7,500, which is classified as eligible taxable income, or ETI, for the purposes of Division 6AA. The eligible assessable income of a prescribed person could also be reduced by what the Commissioner considers appropriate and also by any share of proportionate deductions, for example gifts. The rates of tax applicable to ETI are found in Schedule 11 of the Income Tax Rates Act 1986. The tax rate applicable will depend on the level of ETI received by the minor. So based on Sarah's ETI, the amount of tax payable is calculated using the top marginal tax rate. This amount is payable by the trustee on Sarah's behalf as she is under a legal disability as per Section 98 of the ITAA 36. And lastly, although the trustee pays the tax on Sarah's behalf, she is still required to lodge a tax return, showing both the trust income and her other income. Therefore, the full calculation of Sarah's tax liability is the tax on her eligible taxable income from the trust and tax on her other income. The tax paid by the trustee on Sarah's share of net trust income is then deducted from the income tax assessed against her under Section 100, subsection 2. To recap, you should now understand how to calculate the tax payable of a resident minor. It is important to appreciate the difference between a prescribed person and an accepted person and the different tax rates that apply to accepted assessable income and eligible taxable income.